Hello everyone, and welcome to another episode of Forexer. Analyzing the market structure holds paramount importance for traders, both newcomers and professionals alike. It provides insights into the current trend, potential reversal points, and the overall condition of the market. In this video, we will guide you through the process of reading the chart like a seasoned professional trader. We'll delve into both basics and advanced concepts from ICT on how to decipher market structure and determine its direction. If this is something that piques your interest, please show your support by smashing the like button and consider subscribing if you're new to our channel. Before we begin, let's define what we mean by market structure. Market structure encompasses several key elements, including swing highs and lows, price movements, and areas where the market has previously reacted. All of these components are considered integral parts of the market structure, and they collectively form the framework or skeletons that shapes the movements within the market. Let me share some fundamental concepts regarding XAUUSD market structure. In an ideal uptrend, the market consistently forms higher highs and higher lows. When the market breaks a higher high to the upside, we refer to it as a break of structure. This break signifies the market's intention to continue in the same bullish direction. Conversely, when the market breaks from the high to the upside, we refer to it as a change of character. This change indicates a possible change in trend. Indeed, a break of structure remains valid even if the market produces wicks above the higher high and the demand zone it forms presents a legitimate trading opportunity. However, for a change of character to be confirmed, it requires a break and close below the higher low. Without this confirmation, we continue to regard the market as being in a bullish state. It's important to note that sometimes the market may exhibit limited movement, making these distinctions less clear-cut. The question posed is, which of these breaks are valid and considered a change of character? To address this, we must first identify our swing lows. In a bullish scenario, the lowest point between two consecutive highs is designated as a swing low. For example, if we have two consecutive highs, the lowest point between them serves as our swing low. As long as the price remains above this level, it signifies a bullish market and we primarily seek buying opportunities. A valid change of character requires a candle that not only breaks but also closes below this swing low. In the example provided, there's another break of structure indicated by this moving. Once again, we identify the lowest point between two consecutive highs as the swing low. It's important to note that the same principles apply in a bearish scenario. Now here's another question. When can we confidently say that a change of character will reverse the trend? To answer this question effectively, you need to grasp the fractal nature of the market. Imagine we have a clear uptrend on the 4-hour time frame characterized by a sequence of impulsive and corrective moves. During this trend, the market consistently establishes new higher highs while respecting the higher lows. Now, if you zoom into the 1-hour time frame, you'll observe that the 4-hour impulsive wave comprises both impulsive and corrective moves that still adhere to the higher lows in an ideal scenario. However, in the imperfect scenario, the price may create fake breakouts before ultimately pushing higher to form higher highs. When traders encounter these fake breakouts, they might believe that the price is about to reverse, prompting them to go short in the supply zone. Unfortunately, they often get stopped out. However, if you possess a profound understanding of market structure, you'll recognize that since the higher time frame remains bullish, you should seek out an order block and align yourself with the prevailing uptrend. Indeed, an essential point to consider is that the most favorable trading opportunities arise when both the lower time frame and the higher time frame align in the same direction. This confluence of time frames can provide greater confirmation and higher probability for successful trades. On the Euro-Dollar 1-minute chart, you'll notice the presence of both impulsive and corrective moves. However, when you zoom out to the 5-minute chart, you'll mainly see a different set of moves. The key takeaway here is that trading opportunities tend to make more sense and carry higher conviction when the 1-minute and 5-minute time frames align in the same direction. This alignment helps reduce noise and provides a clearer picture of the prevailing trend. Now that we've covered some of the fundamental concepts regarding market structure, let's transition into the advanced phase. Before we proceed, if you found value in this video thus far, please show your support by giving it a thumbs up and subscribing to our channel. Your support greatly encourages us to create more informative videos like this. Additionally, we welcome your comments and suggestions. Feel free to comment below and let us know what topics you'd like us to explore in future videos. Your input plays a significant role in helping us decide what content to cover next. When delving into ICT concepts, market structure revolves around determining who is in control, whether it's supply or demand. However, it's essential to understand that a valid supply and demand zone must meet three specific criteria. Analyzing the fulfillment or breach of these valid levels enables us to identify the market's direction. The initial criterion for a valid zone is the presence of an imbalance. In this context, imbalance signifies a disparity or lack of proportion between the buyers and sellers within the market. This discrepancy is what ultimately triggers significant and substantial movements in the market. The second feature of a valid zone is that it must break the structure or change the character. The third feature is that it must be unmitigated. Supply and demand zones are one-time use, so the ones which have been mitigated before are no longer considered valid zones for us. If a zone lacks one of these criteria, it won't be considered a valid supply or demand. Now, let me present some common ICT market structure patterns and how we approach them when they appear on the chart. The first pattern is called the market flip. This pattern typically occurs at the end of trends when they become exhausted, resulting in a change in direction. It starts with a valid demand zone featuring a breakup structure and an imbalance. The market attempts to mitigate this level but fail, to create a higher high indicating a loss of momentum. This eventually leads to a change in character and presents an ideal trading opportunity. Therefore, we initiate a short position once the price taps into the supply zone, with our target set at the next unmitigated demand level. On the XAUUSD chart, we observed a clear uptrend until the market reached a valid demand zone, which led to an imbalance and a structural break. Although the market attempted to mitigate this level, it failed to establish a new higher high and eventually broke through it. This represents a valid change in character, creating an excellent supply zone trading opportunity. In this scenario, we consider going short if the price reaches this order block, with our long-term target set at the next unmitigated demand zone ahead of the market. Next, we encounter a common pattern known as the liquidity grab. This pattern unfolds when the majority of traders mistake a fake out for a change in character, while the market continues to move in the same direction upon reaching a valid supply or demand zone. In this scenario, we observe a valid break-in structure without an imbalance. However, upon reviewing the historical data to the left, we identify a pristine, unmitigated demand zone featuring both a structural break and an imbalance. If the market manages to breach this level, we do not interpret it as a change in character. Instead, we actively seek buying opportunities within the demand zone. Here, we observed a consistent pattern of higher highs and higher lows. However, although this demand level broke the structure to the upside, it did not exhibit any signs of imbalance, making it an invalid demand zone. Conversely, as we look back in the historical data, we can identify a flawless imbalance that forms an extreme demand level. Therefore, this change of character is deemed invalid for us, and there's a strong likelihood that this move is a liquidity grab. In response, we will position our buy order a spread size above the order block and target the next level of market structure. It's important to note that these setups offer an excellent risk-to-reward ratio. Even if the win rate is lower than 50%, consistent profitability can be achieved in the long run. It is advisable to take some profits if your analysis proves correct. Why not give HankoTrade a try? Are you ready to dive into the exciting world of trading? Look no further than HankoTrade, the brokerage partner I trust. HankoTrade offers an unparalleled trading experience. When you register and open a real account with us, you'll quickly realize the difference. But that's not all. There's a special treat waiting for you when you make your initial deposit. So what are you waiting for? Click the registration link in the description and take the first step toward trading success with HankoTrade. Your path to financial freedom begins right here. I encourage you to practice these concepts on your charts, and I hope they enhance your understanding of market structure. If you found value in this video, please give it a thumbs up and subscribe if you haven't already. Thank you for watching and see you in the next episode.